All right, time now for business with our very cosmic business editor, Stephen Carroll. Hi, Stephen.
Hi, Jeannie.
A bit more seriously, it is another grim day for the European markets.
Yeah, bump back down to earth for those people involved in the European markets. We've seen fairly hefty falls on the stock markets in the first half of the trading day here in Europe. London, Paris and Frankfurt all down by over 2%, with Paris nearly 4% down a short time ago. That's wiping out this recovery that we'd seen in European shares yesterday and really adding to the falls that we've seen since the start of the week. There's the figures there you can see a short time ago. The sell-off sparked, in the beginning at least, by comments from the Federal Reserve Chair Janet Yellen about the effects that the global growth slowdown and market turmoil could have on the US economy. But banks again are the main focus today. Leading the falls is Société Générale here in Paris. It's down over 11%. That's despite reporting net profits of 4 billion euros last year. There's a sell-off across the European banking sector, not being helped by an interest rate cut announced by Sweden's central bank. Well, to try and understand why all of this is happening, let's go to London now and speak to Craig Erlam, who's a senior market analyst at OANDA. Craig, thanks for joining us. Why are the banks being hammered again today?
Well, I think this just shows how fragile sentiment is around the banks right now. There's been a number of issues really blamed for these low interest rate environment, or negative interest rates really squeezing profit margins. There's the increased exposure to the oil market and what this means for non-performing loans, which has been an issue for the past 5 years really. I think these latest results from SocGen just sparked further concerns. The fact that they warned on potential profitability issues going forward is just another reason to sell, I guess, when we're looking at the markets. And I think the markets are in this negative spiral right now, and it's going to take something possibly quite significant to get them out of it. And I think people are now looking towards the central banks and saying, this is what the banks are doing, this is how investors are reacting, what's your move?
But Mario Draghi has said before that, he's not responsible for banks being profitable. What sort of action could, at this stage, drag them out of this spiral?
Well, I think we do need to see. Well, I think we need to see some more clarity from the banks. We've heard a lot about Deutsche Bank in the last few days, and there's been issues surrounding this. And there's talks about the fact that their balance sheet, say a third of which is unaccountable for what assets they actually own of this over €1 trillion euros worth of assets. So I think we need to see some more transparency, maybe some more clarity on this aspect. But there is things the central banks can do. The central banks have shown previously that they are willing to step in. I guess the worst case scenario in this is that we get some form of credit crunch or credit crisis, even worse, at which point I don't think the central banks will have any option but to step in. But I think really right now what we need is to see a willingness from the central banks to do something to prevent the worst from happening.
Is there any sense that this is really just a sort of a panic spiral, that we've had these, as you say, a lot of these issues aren't new, low interest rates, low oil prices, we knew these problems were around for a while, but all of a sudden we're seeing this slump in banking shares. Is everyone just sort of feeding off each other in some sort of spiral?
I think this has been a theme of 2016 so far, to be honest. We've seen almost 6 weeks now of just pure panic in the market. Initially, it was related to China. There was talk of US interest rates being the cause of the negative spiral. Now it's the banks. There was the commodity story. It seems to be one negative spiral after another. And I think what we're really getting from the markets right now is, one, people are not happy with the way things are. People are uncertain about the future. But also, I think this tells a lot about where the markets were at the start of this year. And what people are saying is there was asset bubbles everywhere, and now we're seeing them deflate.
OK, Craig Erlam at OANDA in London, thanks for joining us.
Thank you.
Thanks to Craig. And Stephen, let's talk about Twitter now, which also is having a bit of a rough time.
And they're expected to have an even worse one when Wall Street opens in a couple of hours. Their shares will be under pressure. This after the company announced it had failed to add any new users over the last 3 months of 2015. Now, growing the number of users is a key measurement for a company like Twitter that has yet to report a profit. Twitter's boss Jack Dorsey says they're working to fix what he called broken windows in the service. William Hildebrandt has more.
It was big enough news to tweet about. For the first time ever, Twitter reported a drop in user growth. Excluding SMS-only users, the company had 305 million monthly users, down 2 million from the previous quarter. Wall Street has been fixated on user gains. Twitter's 300 million pales in comparison to Facebook's 1.5 billion and even Instagram's 400 million, a photo-sharing platform that was launched 4 years after Twitter. The company's earnings were broadcast on Twitter's video app Periscope. CEO Jack Dorsey said management is making new changes to enhance users' experience, including rolling out a new timeline.
We think there's a lot of opportunity in our product to fix some broken windows and some confusing aspects of our service that we know are inhibiting growth. And timeline is a big focus area for that.
But will it be enough to soothe investors? The new timeline uses an algorithm to promote the best tweets rather than the most recent ones. And for better or worse, many users say that makes Twitter less unique and resemble more and more Facebook. Less than 3 years ago, the company went public with a valuation of $25 billion. Today, it stands at less than $10 billion.
All right, Stephen Carroll, thanks so much for that look at the business news today.